Hello and welcome to SwitzerTV Investing. I'm Peter Switzer, and on tonight's program we look at the future of the listed company Freelancer.com with the business's founder and CEO Matt Barry. Has the coronavirus infected world created an opportunity for this business that has 46 million contractors wanting to hook up with a world that has become increasingly relaxed about buying goods and services online? And then we talk to the head of corporate affairs for Vanguard Australia. This is the company that brought index funds and passive investing to the world. He tells us how to invest to reduce the chances of losses. And then Paul Rickard tells us whether the oil and gas player Woodside is a buy, and then he looks at gold. Is Newcrest the stock to play here? But let's just start how we always do and kick off with Birmingham Invest's Julia Lee. And I want to grill her again about Mesoblast and EML payments and any other stock that's grabbed her attention this week. So let's get to it and welcome Julia Lee. Welcome to the program, Julia.
Thanks, Pete.
Now, Julia, I've got to ask these questions. We have our Boom Doom Zoom television program during the week, and people often ask us about Mesoblast or EML payments, and they're two companies that you have a vision on and a view on. Let's start with Mesoblast, because I think it dropped a bit last week, and it's rebounded, and some really important news is coming up soon, isn't it?
We actually topped up on Mesoblast today, so good timing, Pete. I guess with Mesoblast, it's considered to be a high beta stock, which means there's more risk involved in the stock. There's more up movements on up days and more down movements on down days compared to the market. And given that the market has been in the middle of a correction, you'd expect it to correct more than the market, which it has been. The reason I like Mesoblast at the moment is that it's very expensive going through phase 1, phase 2 and phase 3 trials. And I think it's very exciting coming out of phase 3 trials into commercialization. They've already commercialized one of their products for graft versus host over in Japan under the brand name of Temcell. And now they're looking to also get Food and Drug Administration approval to be able to sell this product in the US. The initial decision will be around pediatric use in acute graft versus host, because there's no treatment for this in children under 12, which is pretty devastating. So there is a due date of the 30th of September. We did see an oncology committee vote 9-1 in favor of the drug, and now we're waiting for the FDA to see whether it is approved or not. But aside from that, there's some pretty exciting phase 3 trials coming on. And I like phase 3 because you've gone through the cost of phase 1, phase 2, and you're inching closer to commercialization. And that's for lower back pain. And we know how big a market that is, and the other one is for chronic heart failure. In both of these, commercialization will probably involve being with a partner, which might involve an upfront payment and then royalties coming through, because it's such a huge market. They want to partner up with someone with strong distribution, whereas graft versus host is pretty specialized. So I do like Mesoblast because of the number of catalysts over the next 3 to 4 months. And I think this is an exciting inflection point for the company, moving from consuming capital to hopefully returning on capital.
Okay, Julia, let's imagine on the 30th of September, the answer is yes, thumbs up, green light. What would you expect to happen to the share price?
I'd expect the share price to go up.
Yeah, sure, up. And probably would go up by a fair bit, because there'd be a lot of people who are holding back purely on the basis that it's a gamble. And of course, you're saying that the gamble is becoming a better gamble by the day or by the week. And plus there's two other commodity products that are getting close to the chance of being on the market and selling. So there's like three interesting possibilities for this company. And I guess over the next year or so, you'd expect some real activity, wouldn't you?
Yeah, the uncertainty is we haven't seen MSC products being approved for health uses by the FDA in the US. So it's actually a pivotal moment using stem cells to treat certain diseases. So look, it is a big moment in terms of the health industry and for Mesoblast as well. But you're right, Pete, that in a lot of these decisions, it does tend to be binary, black or white. And you have certain events that start to reduce the risk of a black or white event. And that is that we've seen the Oncology Committee, which has been in favour of the drug. And look, I think that we'll either see approval or we'll see approval with some more work being needed. But ultimately, I do think that we will see commercialisation of this product in the US. There's always a risk that it will be knocked back and it will have to go back and do some more work, which will mean more time and more money. But I believe that this is a company at an inflection point. So different from going through phase 1, phase 2, it's sort of towards the end of the road of commercialization, which is an exciting point.
And for people who don't really understand what you do and how you do it, what percentage of your fund is exposed to Mesoblast?
Look, we have a pretty big holding in Mesoblast. Having said that, it's 7% of the fund. We tend to hold 15 to 25 stocks. So with Mesoblast, given the number of catalysts, and we are in profit in Mesoblast. So look, we're happy holding on to that 7% stake in the fund.
Okay, let's go to EML payments. You're the first person to alert me to the company. People have asked me, and I've said I think it's a company that will do well once reopening happens in Australia and around the world. But what's your latest take on the company?
Yeah, look, Pete, I like this company, but it's obviously not a company for COVID-19 conditions. And we sold this early on in the COVID-19 piece. And that's because 65% of its business has been gift cards, so prepaid gift cards. And of course, with retail closed for a lot of the year, that business has been impacted. The good news is that because of the PFS acquisition, they're looking at that reliance on gift cards moving down from 65% of revenue down to 40% of revenue, but it's still a process. I think looking forward sort of 5 years, this company, I like it because of its exposure to open banking and financial services. So it's really part of that digital banking disruption story, which I do like. But in the short term, I think the shares will continue to come under pressure. And for me, the big test is going to be Christmas because it still has quite a large amount of retail gift card exposure. And so it's really going to depend on how retail recovers in time for that all crucial Christmas period. But this is one that I'd probably be revisiting after the Christmas trading period.
Yeah, and so in many ways, this is a company that will be much better exposed when economies are reopening, there's a vaccine and people are travelling again and we're approaching normalcy. So the long-term investor who's prepared to wait is probably going to get a company like this at a pretty good price.
Yeah, look, I don't like the 3 to 6 month story on this company, but I really like the 5-year view on this company. So it is one for the longer term because it is at the start of its journey and it is changing as a company quite rapidly, especially because of that PFS acquisition that it made over in Europe. But I think digital disruption to the banking sector is going to be a key theme throughout the next 5 to 10 years. And I think EML Payments is in a good place to disrupt it. Unfortunately, some of its more legacy traditional businesses like gift cards and reloading of casino winnings and points and betting, all that stuff has come under pressure because of COVID-19. So it's been, unfortunately, a bad year for EML, but I still like the story. I just want to get through the Christmas trading period before looking at this one.
Okay, Julia, is there any other company that's come on your radar screen in the last year?
There's always companies.
Ones you've actually bought, or ones you've bought. Oh, that's what we want to know.
Yes, we're holding on to Bora because there's an October AGM and they are reviewing their portfolio. And with a lot of investments, I'm always looking for improving outlook or a catalyst. And with Bora, there's that catalyst of that the results of the review of the portfolio and hopefully an unlocking of value there for October. So those shares have been running quite well. And the other one we've been picking up is Bluescope Steel. Now, this is all about steel products, paint-coated steel. And what I really look for is an improvement in the steel spreads. And over the last month, they were up $100 US. So we have seen Bluescope Steel shares rising, but more importantly, I think that signals the bottom of the steel cycle. So I think things will be up and away from here. So we've been pretty happy picking up some Bluescope Steel.
Julia, thanks for joining us.
Thanks, Pete.
This episode was brought to you by WCM Investment Management, a California-based global equities manager with an outstanding long-term track record. This chart shows the significant outperformance of WCM's quality global growth strategy over the past 1 year, 3 years, 5 years, 10 years, and since its inception. Investors can access the strategy via the ASX with their choice of an exchange-traded managed fund, WCMQ, or a listed investment company, WQG.
Well, these are strange times, but a company like Freelancer.com could be a beneficiary of this sort of thing. To explain why and how business is going, with the CEO, Matt Barry. Matt, thanks for coming on the program.
Thanks for having me.
All right, so for people who don't understand what Freelancer.com does, explain.
We're a global marketplace for jobs, so you can think of us like eBay. We have 47 million people on the website now, and any job you can possibly think of, you can get done. So whether it's design for me a website or a logo or maybe some marketing, right through to complicated jobs like astrophysics, aerospace engineering, manufacturing,
the kind of thing that you're known for.
Yeah, lay carpet, paint your wall, walk your dog, any job you can think of. There's over 1,800 different categories now, and you can jump on, post your job for free, and people bid around it and get anything done.
Now, Matt, I would have thought that you were the first mover on this one. How long ago did you start?
It's 11 years now.
Yeah, and there weren't many rivals at that point in time. Because you and I probably talked 9 years ago when you.
There were a lot of little companies out there at the time, probably I would say dozens of little companies, and I went through and I kind of bought up as many as I could along the way and consolidated into Freelancer.com. So today we are the largest network of labourer on the internet globally, 47 million users, and we get 30 to 40,000 new sign-ups a day.
Yeah. We'll talk about the history of the company in a moment, but has the pandemic and people working from home and people thinking, gee, there's so much stuff online I've never thought of before. Has this been of a help for the business?
We've certainly seen that in the second quarter. So in the second quarter, as lockdowns kind of came in and we started this great work online experiment globally, we saw a big lift in traffic and a big lift in economic activity. In June, for example, year on year, we saw a 60% increase in web traffic, a 53% increase in new employers posting jobs on the website, and about a 39% increase in funded jobs. It's really similar to the global financial crisis, but on a much greater scale. So there's really three things that are happening. One is that there are people looking to supplement their incomes by getting work online, and that's not just freelancers, it's also people who have traditionally business owners who are looking to supplement their income while their business maybe can't operate in today's environment. There's also a lot of business owners looking to cut costs, so looking to go to the internet to do so. Also, in many circumstances, they don't want people coming into their physical premises to interview right now. They want to work over the internet. And the third big thing we're seeing is people starting new businesses. So we're seeing a lot of activity around people starting e-commerce websites, Shopify sites. Obviously Shopify's going gangbusters. People are programming games and getting freelancers to kind of put things in the App Store. And we're also seeing a lot of activity around trading online, so getting freelancers to develop algorithms to help them with either share trading or cryptocurrencies or FX trading, and the whole Still Presidente, Robin Hood phenomenon going on.
Isn't the world becoming weird? But it suits you because you kind of anticipate a lot of this stuff. What I find really, this is a question, I know I've asked you this in the past, and if I did, you might have probably hit me to the boundary for 6. But I always thought you had a fantastic idea, but a lot of normal people didn't know about it. But the coronavirus has made normal people hear more about you. And if, say, for example, you were owned by Channel 9, but they let you do exactly what you want to do, so they advertise on TV all the time, there's something called freelancer.com.au, would you have done better because more people would have known about you?
The question is, if you do more marketing, will people know about you? Of course, right? But we're the largest network of users. We have literally 30 to 40,000 more signups per day coming through at the moment.
Yeah.
There's a long way to go because there are about 4 billion people on the internet, so 47 million compared to 4 billion is still a long way to go.
Yeah. Yeah.
I think we're still in very early days of this space. If you think about some of the largest companies by market capitalization, they're global marketplaces of products.
Yeah.
So you've got Alibaba, you've got Amazon, and to a lesser extent eBay, Etsy, and a bunch of other different marketplaces. This will happen in services. It's delayed from products simply because emerging markets didn't go into the internet for at least a decade after it hit the Western world. And on top of that, delivering a website over the internet is a little bit more complicated than selling a book, right? With a book, you know what it is, the consistency and so forth. With a website, it can be quite subjective and things can take a bit longer than necessary. But I think there is huge things that are happening now thanks to COVID. I mean, we've started an enterprise division
thanks
2 years
to
ago.
COVID. That's a consequence of COVID.
Yeah. So we started an enterprise division about 2 years ago. And pre-COVID, global enterprises, the likes of Deloitte, had figured out that in the future, some percentage of their workforce has to come from the cloud. Deloitte, for example, has 440,000 employees. They came to us and said, we know we can't go 10x, because 10x is 4 million staff. That's like the People's Liberation Army of China. That would be unmanageable. And so global C-suite, heads of procurement and so forth from Fortune 200 have universally, before COVID, decided that they know some percentage will come from the cloud. They're not sure if it's 5%, 10% or 20%, but that's sort of the realm they're thinking about. They're not sure if it's this year, next year, 3 years, 5 years, 10 years, but they're getting prepared for that. And then when COVID came along, it's now accelerating. So we're doing all sorts of crazy things now with that division.
And when you say from the cloud, you mean people working basically using the cloud, not necessarily being in an office.
Correct, over the internet, right? So all the questions that these large enterprises were asking for the last probably 5, 6, 7 years were questions like, where will my data be? Who will have access to it? If I use a freelancer somewhere on the other side of the world, will the quality of the work be there? Is this the right paradigm I want to lock myself into? And so forth. And these are all the same questions they asked Amazon about cloud computing. Where will my data be? What happens if I share a resource with someone, etc. and so forth. But now they're pretty much bought off in the fact that this is the future.
Is the insecurity potential still, particularly in the early days, going to be a bit of a problem?
No, I mean, we've done now, I think, almost 18 million projects on the website, and we've never seen a lawsuit or anything like that eventuate from a project around lost IP or anything like that.
Well, I'm just thinking hacking. Like, you can prepare for, normal, decent people, but there are those people out there who look for weaknesses, and often we won't know the weaknesses until it's been exploited by somebody else. Is that?
Well, in many ways, it's actually more secure than the real world, because what we do is all the freelancers get feedback, and the more jobs you do and the better job you do at it, the higher your rating is. And that rating determines how high you appear when you bid on a job and when you're in a directory. And it's very, very, very hard to move up the ratings. So you've got freelancers now, I've got thousands and thousands and thousands of feedbacks, a bit like eBay, and they protect those ratings. If you go with someone who's unrated, yes, it can maybe be a little bit like the Wild West, but you should always be prudent and do your due diligence. But the freelancers with feedback, they want to keep their account, right? And so we have a lot of control over those businesses, actually, far more than the physical world. All
right, so I've always believed that you're in the right space for the right model. You even believe it more than me. But your share price was around $3 or something like that. Then it fell and it's coming back out. Was part of the problem for the company that other people came into space? Like, I'm thinking Canva, for example. They didn't exist when you first started, but they, in a sense, suck in all the design people and that sort of stuff?
No, they don't compete with us.
No.
So they produce design software, and we have probably 10 million designers that many of them would use Canva. So actually, I'm good friends with Cliff and Melanie. But no, we actually don't compete with them. So they compete more with Photoshop and with Microsoft.
But have other people eaten your lunch in certain specialised areas, and so all those people go there rather than
No,
yours?
our closest competitor has 1 million freelancers, and we now have 47 million. Right? In fact, a couple of other platforms have been kicking people off because they want to basically curate those platforms heavily. But no, it's just a case of sometimes it takes time to build a big company. I mean, Amazon's share price went from $0 to I think $6, then back to $1 before it hit 2000.
So is it the spending of money to acquire, to get the size, that has undermined the progress of the share price?
Look.
Well, I'm asking normal people questions.
If you want to talk about the share price, so the share price back when we floated the company, we were a very early stage company at that point in time. We had a takeover that was being launched at the same time by a Japanese firm for $430 million US. We were doing 18 million Australian dollars in forward revenue, right? When that share price opened on day one at 1.1 billion US market cap.
Yeah.
That was a pretty frothy
So it
valuation,
was blue sky
right?
stuff.
So, it had to kind of turn over the register, and it's kind of been a bit of a rocky ride since then, simply because we were growing at 50.0% compound for 6 years in a row. I bought a big business called Escrow.
Explain Escrow to the audience.
Yeah, so this is a phenomenal business. So it's a payment system. You can think of it like PayPal, but instead it's for buying things that are complicated and expensive. So cars, boats, airplanes, jewelry, gemstones, diamonds, shipping containers from overseas. The value proposition is this. Let's say you're selling something from overseas, and you send me photos, you send me, maybe you're selling me a car, right? I see all the information, I see the logbooks, everything looks great. Do you send me the car first, or do I send you the money? Now, you wouldn't be buying it over PayPal. You can't buy it over a credit card because the values are too high. Effectively, what we do is you set up the transaction with escrow.com. We take the money, we put it into trust or into escrow in the US, and then we say you can ship the merchandise, you can receive the merchandise in your location, inspect it, and then you can say release the money.
Yeah.
And so it's if you're importing from China and you want to bring in a bunch of widgets, you can inspect them in your own factory.
Yeah.
So we've just announced actually last week that eBay has selected us. So all watches in the future over $10,000 sold on eBay. No longer can I send that watch to you as a seller to a buyer. It's going to go through a third-party network of authenticators. They'll look at the watch, they'll pull it apart, they'll make sure there's no fake parts in there. They will put a sticker on it, they'll put it in a nice little box with a certificate of authenticity. The funds are secured via escrow.com, and then the buyer will receive the goods, and then if they're happy with them, then they can release the funds.
Yeah.
And so it'd be very, very hard to scam someone on eBay in the future for buying a watch. And that's just off the heels of us being announced in June that we're now securing the cars that are sold on the eBay Motors USA. So in private party transactions, it's optional. With watches above 10,000 it's compulsory, above 2,000 it's optional.
So the escalation of online stuff should be really good for your company.
Correct, yes. And especially now where supply chains are breaking down and there's a lot of distrust out there, escrow is a great payment system because simply we just hold the money in a legal construct known as trust or escrow until you receive the goods, you can inspect them, and then you can release the funds.
Okay, so what are the big initiatives going forward? You've got a lot of big initiatives already, but what's the big initiatives going forward that's going to power this company?
So with escrow, it's really just partnering with the biggest of the biggest, right? So
and when has that started?
Well, it's really just started in the last 12 months.
Okay.
So eBay Motors USA is a pretty big win. eBay Watches is a big win. We secure Shopify for buying and selling Shopify stores. We're in a variety of other car marketplaces. We're in boat marketplaces.
So escrow will be used with Shopify?
Yes, yeah. Well, currently is. It's been the Shopify exchange now for about 2 years.
Okay.
We secure. There's even a space station that someone's trying to get up, the world's first affordable luxury hotel, and you can put money down for a deposit now, and if they get enough money, they'll get off the ground. So we do a lot of art marketplaces. We're inside artsy.net, doing fine art, Artland, and so forth, and so on. So, gemstone marketplaces, commodity marketplaces, people are trading mineral rights and water rights and so on. With Freelancer, we've got a lot of exciting things going on with Freelancer Enterprise. So this is an enterprise division of the business. So with Deloitte, we built them a solution called MyGigs, and this is for Deloitte USA. At the moment, they're onboarding 52,000 consultants, and Deloitte's first point of call is you can send projects to each other within Deloitte. So it's a bit like Freelancer within Deloitte itself. If you click the left-hand button, it goes to Deloitte staff. If you click the right-hand button, it goes to the cloud, goes to freelancers. And Deloitte's publicly said that success for them is 20% of all US consulting gigs going through MyGigs, and 10% of all US consulting gigs going to the cloud, going to freelancers, and those numbers are pretty large numbers. So that's an example of what we're doing there. For a large US computer company, we have a thing called Freelancer Global Fleet, where you can stand up fleets of people to do field services. We've just gone through a pilot in Indonesia, where if your printer or your laptop breaks down, you call the service center, and it goes into our system, and we send out a freelancer who will either repair or replace. That's now rolling into pilots in Australia and India, and there's 13 countries in total that's going to go to. So pretty amazing stuff.
Well, Matt, in the old days when I started this, I would have asked about the profit of your company, but of course we know with tech companies, it's not necessarily a relevant issue. What are the most important profit and loss and balance sheet issues that are relevant to your company?
Well, we were profitable actually for every month of Q2, right? So we've been skirting along profitability actually for the entire history of the company, because I've chosen to spend as much as I can, but not drive deeply negative like the Silicon Valley companies do. But now,
has that worked against you, do you think?
of course it is, because other people want to see you grow at ridiculous revenue rates, which is a bit of a Silicon Valley manufactured thing where you just raise hundreds of millions of dollars, delete the capital of the company, dump it into marketing, and like Uber, you raise money from VCs, then 100 million, put it into marketing, make back maybe 115 million. Raise, show a big revenue ramp. You raise 200, you dump it into marketing, make back 187. Raise $500 million, dump it into marketing, and you show this huge ramp. But all you're doing is burning equity along the way. It's like the Uber model. You get the VCs, late stage VCs, private, public people.
We've seen the
Chinese,
TV program Silicon
the
Valley.
Saudis, the Qataris debt markets, etc.
Yeah.
So, or you go for profitability. We're at the point now though. We've got strong operating leverage in this business. We are basically at profitable. At profitability now, April, May, June, the group was profitable, and both on the Freelancer side and also for some months on the escrow side. And now, if we start getting some real growth in the revenue numbers, you're going to be punching out some EBIT that we won't be able to consume. Because our business is pretty simple. There's very little capex, almost none, de minimis. And the OPEX is really headcount, rent, and a bit of marketing. And my criteria on marketing is a bit different from Silicon Valley's criteria. We just all costs, just throw everything in. I like to make a return on it within a certain time period. So, if I can meet those parameters, I'll put as much money as I can into that channel.
So, do you think your caution, in a sense, your business like caution, has affected the share price in that sense?
I'm building the business for the long term, right? And I'm building for the business for a long term where this is going to be a large company in the future. I mean, what many people don't know is that when I started this business, I bought a very small website for $1.5 million US. I raised no money to operate that business. It was doing about $1 million in revenue. I bootstrapped it to IPO, and it went from 1.5 million to 1.1 billion in 4 years without diluting any equity. Right? Not many people have done that. Right? And I've run that business, in a similar manner all the way through. You have ups and downs. Even Amazon's path to the top hasn't been great. It's been up and down, right? But we're in a pretty solid place right now. We have two very strategic businesses. The largest network of liquid labour in the world, plus the world's largest online escrow business, where the closest competitor has one license, and we're at, I think, 48, 49 at the moment. So we operate in the US, Canada, Australia, and we're just getting a license approved in the UK at the moment. So
Matt Barry,
pretty important.
looking good.
Great, thank you.
Matt Barry, CEO of Freelancer.com. To get a handle on what's going on in the investment world, and a company that really has done spectacularly well over the past few decades, I want to talk to Robin Baumann from Vanguard. Robin, thanks for joining us.
Thanks, Peter. Always good to talk.
Mate, just for people who don't know the history of Vanguard, in a nutshell, what are we talking about?
Well, Vanguard's was started in the US about 40 odd years ago by a pretty legendary investment figure called Jack Bogle, John C. Bogle, prolific sort of author, speaker, really pioneered the use of index funds. So since then, from a very small startup outside Philadelphia, we've grown to be a global company managing about $8+ trillion. And representing the sort of money on behalf of about 30 million clients worldwide. Came to Australia about 20 plus years ago. In fact, next year will be our 25th year in Australia. It was the first office Vanguard actually set up outside the US. And, we've grown to be today 160, 170 billion dollars of Australian investor money here. Yeah. Across both advisors, but also retail customers, a lot of SMSF clients, and we launched the exchange-traded funds about 10 years ago, and obviously there's been a strong uptake in that market.
What was the reaction to the idea of passive investing versus active investing at the time?
I think the famous quote was an American stockbroker who actually described it as un-American. actually had a poster made and distributed around his office. I think the idea of the idea that you would go for if you like the average return from the market as opposed to trying to outperform the market was something that people grappled with for a long period of time. But academics like Professor Burton Malkiel wrote quite a lot of really good analysis, which basically said that for the average investor, you are better off buying the whole market, owning it, as a buy and hold sort of strategy and getting the average, because the average market over the long term typically outperforms, somewhere around 80% of the active managers. And it's not because active management doesn't have a place. Vanguard actually began life as an active manager way back. But it's very hard to actually outperform markets consistently year after year after year. And particularly when you add the dead weight of higher fees. The costs of running active management is actually the thing that actually tends to drag it down. So when people look at their active management stuff, you need to understand what the impact of the fees is going to be on the returns.
Yeah. Has the rise of self-managed super funds in Australia really helped the growth of Vanguard?
Certainly, yeah. I mean, obviously a cohort of investors who are pretty committed, hands-on. I think the term self-managed super fund is a bit of a misnomer. I don't know anyone that actually self-manages their entire superannuation fund. They typically use advisors, accountants, etc. But they're obviously people who like the sense of control, and they tend to want to know what's in the portfolio. So they've certainly been early adopters both of index funds, but then also following the launch of exchange-traded funds, ETFs. SMSFs were really the early adopters. In the first couple of years, it was about 60% of the ETFs were owned by self-managed super funds. And I think one of the great things with the ETFs is they effectively democratized investing in a sense. They actually put the tools that were in the hands of large institutional investors, the ability to buy a whole segment of the market or a whole market, and then balance your asset allocation that way. It sort of brought that into the world of an SMSF where they can buy, if they believe the US market's going to go up, they can take a view on that. If they think they want more in Australian equities, they can weight it that way. These are very powerful tools at very low cost, and it's the low cost that actually really helps.
How many products does Vanguard have in Australia nowadays?
We've got about 81 funds in Australia and about 20 plus ETFs. So a good range across most of the or all the major asset classes. We're not a company that believes in a lot of product proliferation. We typically think people should be in funds that are well diversified, broad market indexes, as opposed to very specialty niche boutique type products.
Yeah. So you haven't gone into hacks and robos and all those sorts of things?
No. We try and keep it pretty simple. So I think one of the good messages for people with the Vanguard products is, you should be able to understand exactly the sort of product that you're actually investing in.
What's the most popular, mate?
Actually, it's the Australian Share Fund, the Vanguard Australian Shares Index, both on the fund side, but also on particularly through the COVID period of volatility. A lot of people, I think, were obviously seeing the market in sell-off, so people saw there was a discount on offer, so they were buying into the Australian Shares Fund. We saw trading about 4 times higher than what we did the year before. Interestingly, in the last month, July, August numbers are just coming out. It looks like there's more of an appetite there for international equities.
Yeah, can you explain why, do you think?
Well, I think basically people are understanding that they're resetting the portfolio. They're also looking at what's happening. I think the US market's obviously been on a good growth. The Australian market is probably a little, it recovered very well, but it's still down 9%, I think, calendar year. So I think people just tended to look at what the opportunities there are overseas and a way to diversify. And again, with ETFs, it's very simple to be able to buy the exchange, the international fund. You can buy the US fund, you can buy the global market, you can buy international fixed interest. So you can buy these asset classes which allow you to diversify.
I'm not going to call you an old hand, that would be terribly ageist of me, but let me call you an experienced man when it comes to this area. Do you worry that the S&P 500 has been over affected by the FANG stocks?
Well, I think markets move in and out of cycles. As you say, been around the markets here for quite some time. You see things come in and out of fashion. Obviously, there's a lot of earnings momentum at the moment, but I think the key point there is obviously those stocks have actually had a great performance. But for an individual investor, particularly an SMSF type investor, it's about actually looking at the portfolio and understanding how much risk have you got in there. If the FANG stocks, for example, were to drop 20% over the next 3 months. What damage would that do to your portfolio?
Yeah.
Would that be a so what, doesn't matter because it's only 10% of the portfolio, or is it 80% of the portfolio and it hurts a lot? So I think it's about people understanding what the risk is within the portfolio, as opposed to, as we know, from a behavioural finance point of view, very easy for investors to get sucked into following past performance. You see something that's gone really well, you instead of factoring in the risks, you tend to think about, I'm missing out here, I need to get on board the bus. So I think it's about understanding what's your life stage, what's your horizon. Are you early years of retirement? Are you a 30-year-old, in which case you want to take more risk, etc.? These are all the sort of things that people need to think about, as opposed to simply whether one or two stocks are doing something.
Do you, at the moment, tech stocks are selling off in the US. Do you suspect that we're going to see a rotation into more traditional stocks that benefit from, hopefully, an economic recovery in 2021?
Yeah, I mean, I think we're thinking, obviously, from a Vanguard economics point of view, sort of a subdued, obviously, into the first quarter next year. But, the second half of next year, probably more of a recovery. So I think, that's probably quite reasonable. But again, markets can be fickle. And as you know, certain parts of the markets can run really hot, but inevitably they will then cool down. So again, it comes back to the point about just make sure you keep a level of diversification in the portfolio, not so much because you're trying to chase return, but because you're trying to manage your risk. And as we know, we're living in pretty uncertain times.
Yeah, without a doubt. Now, Robin, for those young people out there who may well have jumped in, use online brokers or maybe even use Vanguard products and bought at the bottom and have ridden up nicely and made a bit of money, what advice would you give them at this point in time? While they're probably still in the money.
Well, I think I'd say for a start, make sure you understand where you're at. How's the portfolio going? And then if you have, as you said, perhaps bought a 2 or 3 stocks, handful of stocks, got started, great, you're into the market, you understand the investing thing. But take a chance now to think about it from a portfolio point of view. It's not about should you buy stock A, stock B, fund A, fund B. It's actually about what's the portfolio you're trying to put together here. Is it an Australian equities portfolio? Is it a well-diversified global equities portfolio? What's your time horizon? As I said, bring it back to the risk equation, what works for you. So I think it's one of the mistakes we see individual investors make a lot is they focus on the specific security. Should you buy the bank A, bank B? What about thinking about should you have exposure to property? Should you have exposure to industry, to infrastructure? What are the asset classes that you want within the portfolio to make sure it's diversified? And then, build the portfolio around that. But I think it's typically that one of the mistakes we see people make is that they don't take that top-down view of the portfolio. It's more a stock-specific sort of view about whether, the Commonwealth Bank is better buy than NAB Bank. This sort of where people are focusing on that. The actuarial sort of studies, research will tell you that stock selection probably adds somewhere between 2 and 5% to a portfolio. Your asset allocation decision, how much you've got in cash, how much you've got in property, how much you've got in shares, that's what drives 80+% of your portfolio's return.
Yeah, now my last question to you would be one that you won't know the answer to, but I know you would have at least had an opinion, and I know from my point of view, I'm saying the great game changer for both the economy and ultimately the stock market over 2021 will be the arrival of a vaccine. If we do see a vaccine by the end of the year and people are jabbing themselves by January, do you suspect that we will see a reasonable economic recovery and the stock market will avoid another sell-off?
Well, I certainly look forward to the vaccine idea. I think obviously that's the as you said, that's the game changer. Once the vaccine not only gets developed, proven safely, but then actually gets distributed to people so they can do it. I think that then you will see. You should expect something of a rapid sort of rebound. I certainly know. Where I'm based down in Melbourne and Victoria, I think that the rebound economically will actually be pretty strong, short and sharp initially, simply because businesses will be back open.
Yeah.
Then I think it'll flow. You may get a settling down and sort of looking out over the longer period of time for businesses to get back to whatever the new normal is, even with a vaccine.
Well, mate, great to talk to you. If anyone wants to know more about Vanguard, what's the website?
Vanguard.com.au.
Simple
Very
as that.
simple.
Yeah. Robin, thanks for joining us.
We like to keep it simple, Peter.
Yeah, I know. You made the complex world of investing simple, and you've made a bit of money out of it too. Robin, thanks for joining us.
My pleasure, Peter. Thank you.
Well, I keep getting questions from people about gold. Is it too late to get into gold? If I'm going to get into gold, what stock should I get into? And also oil, the same thing happens. Oil is something that people wants to know. It's been sold off around the coronavirus, and now people want to know whether it's time to get into it. Now, Paul Rickard in the Switzer report today actually looked at Woodside, Paul?
Yeah, I looked at Woodside, Peter, because it's down at $18, and I think a lot of investors have seen Woodside in the 40s.
Yeah.
If you look 10 years ago, it was well and truly in the 40s. It was in the high 30s just a couple of years ago now. What's it doing at $18? And really has been a non-performer since it, really the last couple of months, I guess.
But is there quality company in that oil sector?
Yeah, I mean, look, it certainly has some great assets. I mean, Woodside is a great Australian success story in terms of the developments and the projects it's done, the Northwest Shelf, the Pluto. They've opened up a whole new world for Australian, industry and exports. And we are, I think, if not number one, certainly in the top couple in terms of LNG exporters. But it hasn't been a great job for shareholders, Peter. So it's one of those companies that's done, I think you'd say, as one of our marquee companies in a global perspective.
But it's underperformed.
But shareholders have had a pretty rough trot, particularly over the last 20 years. Now, going back, I mean, I originally bought Woodside. Peter, was the first share I ever bought in 1978. I think I paid $2.
So you got formed with this company.
And I sold out at about $4. So it's one of the reasons I have a fond memory. But I've also bought it in the 40s. I remember when Shell tried to buy it out in 2001. It was the takeover that famously Peter Costello knocked back on national interest grounds.
A lot of shareholders would have hated Costello over that.
It was over $40, and then that was 20 years ago, and here it is today at $18, and Shell's since sold out, and it's really been a struggle. So
Paul, is a part of the problem with the current share price that oil prices really fell with the coronavirus? If we hadn't had the coronavirus, do you think this would be a $20-odd stock or even higher?
Look, I think it could be back in the 30s, Peter. Certainly the coronavirus is part of it. The other thing that's also happened is that LNG, the demand for LNG, whereas 5 years ago people were talking about global demand for gas and shortage, some of that hasn't quite materialised as countries have become more efficient. There've been more exports. You've seen the whole market in Queensland with Gladstone open up. And Woodside, perhaps the LNG price has actually done relatively worse in some cases than the oil price. It's a derivative of the oil market, but it's not exactly the same price. So that's one of the reasons Woodside lags. But you're right, certainly the stuffing in the market was knocked out with the oil price in February, March. And Woodside, it did come back into the 20s, but it really has drifted off again the last couple of months.
So at $18, let's just do it in time sequences. Over the next year, would you expect a big improvement, or do you we're going to need longer?
I think we're going to need a bit longer. I think one of the reasons it's down to $18 is the market's sort of, worried about a capital raising. Now, there are a couple of things driving that. One is, first of all, Woodside has some massive projects potentially it could do. Things like Scarborough, the Browse development, the second Pluto train. They'll all take a lot of money. Now, if they happen. So at the moment, the decision on that has been deferred, but the market's saying if Woodside is really to get into the next go into the next phase, there'll be a lot of money required to build these projects. And the other reason is it's one of the joint venture partners in the Northwest Shelf, which was Woodside's first project. Woodside is the operator and owns a sixth, along with companies like Shell and BP and BHP. But another one of the partners, Chevron, has currently got its 1/6 stake on the market. Now, because Woodside's the operator and also potentially has some synergies with what's known as its Scarborough project, it's seen by the market as being the natural buyer. Now, that stake could possibly be, $4 billion US. If Woodside was to buy it, they'd have to raise capital.
They raise capital, and that takes the share price down.
So the market sort of say, well, we think at some stage you're going to have to raise capital. Not sure what it is, and so why buy the shares now? And that's one of the reasons why they've come down. And when you've got that sort of cloud over a stock, it's really hard for the share price to go up.
Yeah. So if that came about and they bought it, would that improve the long-term profitability of Woodside?
Look, I think it'd be positive for two reasons. Yes, because it's a joint venture, and when you've got 6 partners, they've all got, it's very hard to get agreement amongst the 6 partners to do things. So certainly if Woodside was to move to a 1/3 share or a half share, if another partner sells as well, that'll give it a much better chance of actually controlling the destiny of the project. That would be a positive. It would also potentially be positive for what I said as the Scarborough project, because there's viewed to be some synergies that could come out of the Northwest Shelf and that project, particularly if Woodside was to operate both. So I would think that would be a positive for the market, assuming it doesn't pay a crazy price.
Yeah, okay.
And so that's probably the only issue. So I think that would be a positive, but because it would have to raise capital to do it, people would say, I'll take part in the capital issue rather than buying the shares now.
If you had no oil and gas producer in your portfolio, would you still go for Woodside over, say, Santos?
I think I'd probably still look at Woodside, but I think Woodside at $18 is certainly in the cheap category. The analysts have a valuation of about $23.50 on it.
Okay.
So that's lots of upside. But I think you might have to wait 3 to 5 years. So it's probably, it's a stock
For the patient investor.
Yeah, and that's exactly the words I used at the bottom of the article today. You're going to need to be patient on Woodside.
Okay.
It is a great company.
Yeah.
It is a lot more disciplined than it used to be. It's well managed. It is had record production in the last half, so it's got its sort of focus right, but it obviously can't control the LNG price, and it can't control what its partners are doing with some of these projects. And they are super capital intensive, Peter.
Let's quickly go to Newcrest now, and I know with the webinar we did with June Bailu from Tribeca Partners, she said she liked Newcrest. A lot of other people do as well. Is it too late to get into gold?
Look, it's probably not too late to get into gold. I've sort of gone off. I think gold is so much tied into the US dollar, and the challenge there obviously is the US dollar weakens, the gold price goes up in US dollars, but in Australian dollars, which we all look at it doesn't mean quite so much. So it's not quite as attractive so longer in Australian dollars, which is really important for us.
Are you saying that the rising value of the Australian dollar undermines the ultimate?
It does a little bit, and that's one of the reasons why the gold producers here have come off the boil a little bit. So you can be very bullish on the gold price. You can look at doing a lot of work between around 1950 US dollars. It had one go at $2,000, it's bounced off. Probably the chartists will say it's in a long-term uptrend. We'll have another go at $2,000. But if the US dollar weakens and the Aussie dollar goes up, some of those gains are going to disappear.
Okay.
So that's one thing.
Yep.
And two, look, I mean, I guess you've got to say maybe the best part of it is behind you. So I think in weakness, gold's probably makes some sense in a portfolio. Whether you play through the stocks or the ETF, I probably prefer the ETF, but of the gold miners, Newcrest is the biggest. It's probably done the least well of some of the miners in terms of recent share market. And I think probably Newcrest looks like the one that looks the most interesting.
And what about if a vaccine is found, Paul? Do you think the optimism around that will push stock markets up and gold price down?
Well, I think it's would be a temporary negative to the gold price, Peter. I think you've been keen about that to say that there is a little bit of vaccine or COVID-19 risks built into gold.
Yeah.
I don't think that's fundamentally what's driving gold. I think it is still the US budget deficit, the burgeoning US money supply.
Yeah.
Just everywhere central banks around the world are printing more cash or more money. So gold is going up. Interest rates are at 0%. To get the change in the gold market trend, we're going to need some inflation.
Yeah.
Right?
Yeah.
And we're going to need to see interest rates go up, But probably interest rates go up, I think, is probably the key. I don't think that's going to happen. But I do think if a vaccine was discovered, that will be a short-term negative for gold. That might be the buying opportunity.
Yeah, and the interesting thing is, and I often call this Suzanne economics, Paul, this goes with this, goes with this, goes with this, is that if we get a vaccine and the gold price falls, and the vaccine then helps a surge of economic growth, with all this money out there, we'll probably get the inflation. Interest rates will start rising, and that's when gold becomes attractive again.
Yeah.
Okay, but there are a few moving pieces.
Yeah, look, to be honest, it is well supported. It's not showing any signs of weakness. The technicals will say, the long trend is in place. So it's a buy and weakness type commodity. But I think maybe you've got to just be a bit patient, and maybe the miners and people like Newcrest offer potentially some better value there at the moment.
Okay, well, that's Paul Rickard, and if you want to see that story, go to switzerreport.com.au. If you're not a subscriber, take a free 21-day trial. That's the show for tonight. Thanks for joining us. We'll see you next week.